Happy New Year, everybody. 2026 has arrived. I don't know, as the older I get, the calendar seems to flip faster and faster. I hope you all had a fantastic holiday season and the big elf found you and treated you well. 2025 was a great year in the markets, as we all know, and was likely better than most of us expected it to be. So let's take some time. We'll go through here. I'll share my screen and let's have a little snapshot of what the year was, and we'll have a little forward look and try to anticipate what this year will bring. Let's have a look here. As we go through the calendar, here are the performance numbers for the Canadian equity market. The TSX had a very strong year, up 28%. The TSX small cap, which had been relatively quiet along with the venture exchange for a number of years, was up 47 and 65% respectively. That was higher than the US market, the S&P 500, the broad-based market, up 16%, the Dow Jones, which we really don't follow that closely as it represents just 30 stocks, was up 13%, and the tech-heavy NASDAQ was up 20.4. But it really was strong globally. The world index was up about 17%. Europe had a very strong showing, up 28%. Emerging markets up 28% as well. If we break it down a little bit further, 21 from the UK, about 10 from France. Germany was strong at 23. Japan was up there at the top of the list, up 26%, and China was up 18%. You know, when we break it down, I think this is really important to take a look at. With the TSX, as you know, was up 28% on the year. There are 11 subcategories that make up the market. Materials, think of gold, was up 98.2%. It represents 18% of the S&P TSX. Financials was up 30%. They represent 33% of the index. Consumer discretionary was up 28%, but it has a light weighting, just 3.3% in the index. Other categories that did not keep up with the index, IT was a little bit lower at 23%. Utilities made up 15%. Energy was up 14%. Consumer staples was up 11.2%. Real estate 4.3%. Communication services was 4%. Industrials was 2%. But if you look at our so-called Canadian healthcare index, it was actually down 2% on the year, but has a remarkably small weighting in the index of 1/3%. And, you know, sadly, our healthcare index is largely made up of pot stocks. We do not have many publicly traded healthcare companies in Canada, which is why it's important to invest globally, you know, get that exposure through the US and international. You know, comparatively, you look at the US market, the same 11 subcategories largely. Communication services was the strongest category in the US, up 30%. But in Canada, it was the third last category, up just about 4% on the year. So big differences whether you're north or south of the border. IT was up 22%, which was reflective of the performance in Canada. The S&P as a whole, as you know, was up 17%. When you look further down the list, financials had roughly half the performance in the US versus Canada. Material space was up 15% versus 98% in Canada. But look at the tiny weighting it has in the US, under 2%. Healthcare was up 14%, utilities was up 11%, and as you move down the list, real estate was relatively flat, but it is a small category south of the border and in Canada as well. So what does this bull market look like compared to previous bull markets? You know, the red here indicates, the bull market now has had its third birthday. Historically, bull markets that reach their third birthday usually tend to have some legs. And you can see that in 1982, 74, 2009, and 1987 were particularly long bull markets. We've outlasted the one of 2020. The biggest driver as we move forward, the biggest driver for the direction of the stock market is earnings. You know, the stronger the performance of earnings, the more money that financial institutions and corporations make, the better performance of their stock market. As we look forward, earnings are expected to remain strong, which is a good indication for the direction of the market. However, if we pause and we take a look here, if we look at the US market, it's trading at about 22 times earnings versus its long-term average of 17 times earnings. So by that simple metric, it is a standard deviation plus above what the 30-year long-term average is. So what we're hoping here is what we want to see is we want to see earnings remain strong and grow into that multiple. What we also like to do is talk about kind of the breakdown of the markets as a whole. As we indicated with some previous slides here earlier, is that there are 11 subcategories that make up the market. Just because the market had a specific performance, it's often driven by a handful of categories, not all categories. Doesn't mean just because the market was up 25% on the year that all stocks were up 25% on the year. So one of the things that we watch closely is the concentration in the S&P 500. It is a basket of 500 stocks. The 10 largest stocks now represent 40% of the entire index, which means the other 490 stocks make up the other 60% of the index. So with 10 names representing 40% of the index, they will be the big driver for the direction of the index as a whole. But what's interesting is, even though these 10 large stocks represent 40% of the index, they are responsible for 32.5% of the earnings in that index. So there is a reason that these are behemoth companies because they are extremely profitable and drive very large earnings. In the past, the Magnificent Seven, as we all know, are NVIDIA, Meta, Tesla, Amazon, Google, Alphabet, Microsoft, Apple. In 2023, they were a huge driver of the performance of the S&P 500. Less so in 2024, and even less so in 2025. So what are those 10 big names? And this is when you look back over this history of 40 years, and we talked about this, in a previous quarterly report, 40 years ago, the 10 largest stocks in the US represented a market cap of 251 billion. Today, the 10 largest companies in the US represent a value of $20 trillion, which is a significant, 3 or 4 times the value, arguably even close to 5 times the value of the entire Canadian stock market. Those names represent JP Morgan, Berkshire, Broadcom, Tesla, Meta, Alphabet, which is Google, Amazon, Microsoft, NVIDIA, and Apple. Value continues to remain at a discount. If we look here, the long-term average is a 30% discount to growth stocks. Right now, they're trading at about a 40% discount. The long-term average earnings multiple on value stocks in the US is typically about 14 times. It's now 17 times compared to 21 times for growth stocks and currently 28 times earnings. This little slide is a great reminder. So in the last 3 years, the market was up 24%. 2 years ago was up 23, and last year we're kind of looking at broad-based to 16%. But there is a particular point in time during the year that the market is negative. And so if you think last year, go back to the point in time, it was earlier in the year, Trump was in the Rose Garden, which is now concrete, but he had his tariff boards and he was introducing tariffs. And at that point in time, the market rolled over, was down 19%. It felt heavy. It felt dark. Personally, I was one that kind of felt at that point in time, if we finished the year flat, that would feel like a win, let alone a double-digit gain of 16%. So it's just a friendly reminder, that, negative news tends to pass, that the sun will set and the sun will rise. Don't let the heavy news cycle weigh in on you. The market has been positive 35 out of the last 46 years. There's a lot of talk about the economy. And if you look at in the US, which is the largest market in the world, which is why we spend a lot of time talking about it, the 30-year average for wage growth, 3.4%. It's currently 3.9. So wage growth remains above the 30-year average. The unemployment rate historically over the last 30 years has been 5.5%. It's lower than that at 4.6%. So if you kind of look at those comparables, unemployment remains below the long-term average. Wage growth remains above the long-term average. That's a positive trend. Tariffs is a big topic. And I think what's interesting here as we reflect in April when the tariffs came into place, they kind of peaked at 30%. They ended the year at 15.6%, half of that. But what I think is really important is to take a step back and kind of understand what is the effective tariff rate, because not all goods that come into the US have a tariff attached to them. So if we look at kind of over the course of the year, we don't have the data for the rest of the year. There's a delay in getting it. But in September, as an example, tariff revenue for the US was $30 billion. Imports were $276 billion, tariff rate of 10.8%. But if we look over the calendar year, for the first 3 quarters of the year, tariff revenue was 174 billion on about 2.6 trillion in imports, which created an effective tariff rate of about 6.7%, which is, again, half of what the peak was at the end of the year. So where do we go from next? What's the consumer confidence like with regards to the stock market? Here we sit at the end of the year at a level of 52.9. When we look at these blue dots, what that tells us is where was the market 12 months prior? So if we go back to November 2008, this was where a similar point in time, 12 months later, the market was 22.2% higher. This point in August, the market was 15.4% higher. Back here in April of 2020, a low, kind of in the 65 range, the market was 43% higher. So this is kind of a bit of a bullish indicator that sentiment is low. And so we quite conceivably could have a good year in 2026. As you know, we are global investors. We feel that it's really important to have a global diversified portfolio. And it tends to be the US versus the rest of the world. And what's interesting here is when the US dollar is declining, here in the late 70s, here in the late 80s, early 90s. Again, back during, leading up to the financial crisis, that the US dollar was weakening. That was a period of time where international developed markets outperformed the US. As you can see, we're going into a period of time here where the US dollar seems to be softening a little bit, which should bode well for that developed market, international Europe securities. This chart shows you what was the leaders last year. The number one performing category in 2025 was emerging markets, followed by developed markets. So think of international, particularly Europe. Those were the 2 largest categories outside of Canada and outside of the US. The next largest category, the best performing category, was US large cap stocks. We've had 3 great years in the market. We get a lot of questions that say, Chris, the market feels high right now. I've got extra money, I want to invest it. I'm worried about the timing of the market. We are believers that it is extremely difficult to time the market. But what this chart should provide you a little bit of comfort is investing on any market day or investing when the market makes a new high. And look at it, just shows here, we shouldn't be nervous. We should be enthusiastic when the market is doing well. And if the market made a new high and you invested a year later, on average, it's a 14% gain after a new high. 2 years, 3 years, 5 years. So it really shows you that when there is strength in the market, that is when you should be putting your money to work. Let's have a look at the Canadian market now. The Canadian market compared to the US trades at a price earnings multiple of about 16.5%, which is lower than the US in terms of valuations. The long-term average, it is still expensive. The long-term average is about 16.6% is where we are today versus the long-term average of about 14.85, roughly 15%. So it is 15 times earnings, sorry. It's trading at a multiple, that's one standard deviation higher than what the norm is. Again, go back to the Canadian market, up 28% this year. But again, as a friendly reminder, there was a period of time where the Canadian market was down 13% during the calendar year. We are likely to see, some declines in 2026. We're likely to see some volatility. One of the things that we really stress with our clientele is the importance of not necessarily looking at the dollars, but understanding it more in terms of a percentage, if you will. As the market has done so well for the last 3 years, portfolios are at or near all-time highs. People have more money than they historically have ever had. So the next downturn is likely to feel bigger than what it really is. As an example, and this is maybe an extreme example, but I think it carries the point well. If one was to have $10,000 and we had a 10% correction in the market, that's $1,000. And not to discount the value of $1,000, but life is expensive. And, $1,000 is today's world would likely not be noticed that significantly. However, a portfolio of $5 million, a 10% correction would be, $500,000. They're both 10%. But as the value of your portfolio rises, a correction in the market is likely to feel bigger. It's not necessarily bigger, it's just how it feels. So as a reminder, if we do get that correction, think of it in terms of percentages instead of dollars. This is a great breakdown on the Canadian market, and what we kind of touched on earlier, the 11 categories that make up the market. So of the 28.2% return, 11% of it came from the material space. Think of gold, that category that was up 98%. Financials represented, 10%. So the other 9 categories that make up the market added just roughly 7% of the 28% return. All of the return in the Canadian market largely came from golds and financials during calendar year 2025. So as we move forward, 2026 should be an interesting year. There's lots to look forward to. I am a sports junkie and a political junkie. So, 2026 should be a very exciting year for me, something that happens every 4 years. We have the Olympics, we've got the FIFA World Cup, and we've got the US midterms. So we should all find something that we're looking forward to in 2026. The news cycle can be heavy. Let's have some fun. Let's enjoy life and make the best of it. Please feel free to reach out to us should you have any questions or concerns. We love talking to you. Thanks and enjoy your day.